Hello and welcome to Portfolio Matters. In today's episode of Share Talk, we will be talking about the small UK listed chain of Lebanese restaurants called Comptoir Group. And thank you to our Discord member, Sahil, for recommending this company. And we're taking a look at it because, frankly, it's interesting and we needed a break from looking at resource companies. So before we get into it, Richard will read the disclaimer.
Thanks, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Keith, tell us about Comptoir.
Okay, first of all, we have done a separate small video on an introduction to IFRS 16 for investors. And in order to understand the accounts of Comptoir Group, I'm afraid you're going to have to watch that video, which explains the recent changes to how leases are accounted for, and the changes that in IFRS 16 you will see as we go through this have changed the P&L of Comptoir Group and made them more difficult to interpret. Okay, so who are Comptoir Group? Well, they run various chains of Lebanese restaurants centered around the celebrity chef Tony Kitous, and there are various different chains, but the main one is Comptoir Libanais, which I have been to, and where the food is very good and the restaurants themselves are very attractively kitted out, as you can see from this photo here. And it has 23 directly owned restaurants and 4 franchises. So current share price is 7p and the current market cap is about 9 million. It's got 7.8 million pounds worth of cash on the balance sheet, but it has debts, including the recent government support loans that were brought in during COVID, which is taken out to the tune of 2.5 million, and lots of lease liabilities. Last year was obviously a very poor year, and revenue declined by 60% to 12.5 million. Now, in summary, Comptoir Group has never made a profit. And when we go through the accounts, you'll see within a year of listing, it was warning on wage and food price inflation. And we are seeing wage and food price inflation right now. Now, the restaurant group, which owns Wagamama, has recently reported good trading, and it is likely that Comptoir Group will also be benefiting from good trading right now. But we suspect that that will be transient before wage and food price inflation once more squeezes margins down to zero. So we do not think that this is likely to be a good long-term investment. In addition, management own about 60% of the shares, and various fund managers between them and management have about 90% of shares locked up. So the shares are very illiquid, and because of the high management shareholding, there is no chance of a hostile takeover. So an investor's prospects for crystallizing value are limited. So hence, we are not very keen on Comptoir Group. Okay, so let's have a look at its listed history. Well, it's been listed on the stock market since June 2016, where it raised 16 million in an IPO at 50p. 8 million was for expansion, 8 million for selling shareholders. And the company then had 11 restaurants. In that year, it opened 6 new restaurants: Poland Street, which has since closed, Gloucester Road, which is still open, one in the John Lewis Oxford Street, which has since closed, Bath, still open, Exeter, still open, Leeds, which is due to close next year. And then in 2016, it also acquired the Yala Yala chain of 3 Lebanese restaurants for 400k, and 2 of those are still extant. But then within a year of listing, it had a profits warning that it's seeing margins squeezed by food and wage inflation, and the share price collapsed and has frankly never recovered. And it has had a bit of a blip up in the last year and then drift off again. But last year obviously was an incredibly bad year for all restaurants because of COVID and the lockdowns. And it has recently reopened. And as I just said, the restaurant group has reported strong earnings, and we suspect that Comptoir group will also be doing pretty well currently. So these are the locations of Comptoir Libanais, and they're all very nicely kitted out. There are currently 23 restaurants listed on the website. And if you go on Restaurant Guru, Comptoir Libanais gets generally very good reviews, or good reviews. Now, their other chain, which they bought, Yala Yala, there are 2 remaining. And Tony, if you go onto their website, Tony Cattouse likes to put himself center stage, and he has his own website, which lists all of the Comptoir Group's restaurants as being linked to him. And he, so it's a sort of chain centered around Tony Cattouse, who presents himself as a celebrity chef or celebrity, entrepreneur in Lebanese food. And these are the 2 remaining sites, both in London, one in Fitzrovia, one in Soho. Then there's the Shawa chain, which is Lebanese village food, but is actually really a kebab shop. And there's only one left, and that's in Bluewater. Again, Tony Cattouse, center stage, and it gets, frankly, pretty terrible reviews. Then it owns 2 high-end restaurants, Levant and Kenza. Levant is in Wigmore Street in London. Kenza is in Devonshire Square. And then it owns Feasts from the Middle East, which is a catering service providing Lebanese food for parties, etc., and events. And that was launched in June 2019. And frankly, all this, I wouldn't have found it unless I'd gone to Tony Cattouse's personal website, where it's all listed. Comptoir Group is a sort of conglomerate of different restaurant chains. Okay, so this is Tony Cattouse's personal website. It's got all the restaurants listed, etc. And this is Comptoir Group is his personal fiefdom. Okay, let's go through the 2020 annual report. And it is ugly, as you would expect. So revenue was down 63%. Gross profit was down 63% as well. Adjusted EBITDA, and because of IFRS 16, we would be very wary of EBITDA. And please watch our separate video on IFRS 16 for a discussion of that. And it then had an IFRS loss of 8.1 million. Now, bear in mind, that's its current market cap, but that included an impairment charge of 4 million and was partly offset by a reduction in its lease liabilities as it negotiated lease concessions from landlords. But it also has a lot of cash. It's got cash of 7.8 million, and it generated 2.7 million in cash from its operations last year, almost entirely from changes in working capital, and we'll go through that. Okay, so just let's go through a year under COVID, and all restaurants will have suffered from similar pressures. So the first lockdown, all the restaurants were closed between 19th of March 2020 and 4th of July. And then they began a phased reopening of 8 sites. Then we had the Help Out to Eat Out scheme during August last year, which they were saying was very beneficial. But then the next month, social mixing rules began to apply with the rule of 6, and the 10 p.m. closing time was also imposed. Then in mid-October, a tier system was introduced and followed by second lockdown. And so from the 5th of November, all the sites were closed again. On the 2nd of December, some sites reopened, but trading was disappointing. And by Christmas, only 3 restaurants remained open for eat-in trade. And then, of course, finally, in early 2021, there was third lockdown between the 5th of January and the 12th of April, when some restaurants reopened with outdoor seating only. So a very disruptive year. And a lot of these COVID regulations were announced with very little warning, and that meant there were inventory write-offs because they had to throw away food and they had other short-term costs. They put all employees, apart from a small number of central support staff, on furlough and halved directors' salaries. But they did manage to negotiate with landlords some rent waivers and rent deferments, and also to take rent payments from their deposits. And some landlords also agreed to a variation in the lease whereby they would take a turnover-based rent. And they also closed some underperforming restaurants. So 2 franchise restaurants in Gatwick and Heathrow both closed permanently in March 2020. Levant Street was handed back to the restaurant in December 2020. Poland Street and Haymarket have both closed, and Leeds is due to close. So it's high graded its portfolio. Going forward, it still aims to grow the brands, to grow Comptoir Lebanese, which we've seen has potential, and Shawa, which we've seen there's only one of them and it doesn't get very good reviews, and it's a kebab chain. And when I look at the high street, there are lots of independent kebab shops. And what is the prospect for a sort of high-end kebab shop? Not sure. But its franchise partner, HMS Hosts, it remains keen and is due to open 2 new sites this year. And I believe the Doha site is now open, but they're also due to open one in Abu Dhabi. Okay, so going through their financial statements now. So this is the income statement. You will see they report revenue, cost of sales, and a big gross profit. So it looks like they've got margins of, what's that, 75%. But then underneath that, they've got distribution expenses. Now, shouldn't that be in cost of sales? And then they have absolutely enormous administrative expenses for the size of this company. So let's take 2019 as an average year unaffected by COVID. You'll see they had gross revenues of 33 million, but administrative expenses of 16.7 million. Now, those administrative expenses are just far too big for this size of restaurant chain. It seems under scale, or they've got far too many staff. And as a result, in 2019, they claimed to have made 580 grand at an operating level. But remember, under IFRS 16, that excludes rents, which are now part of financing costs. And so after accounting for rent, they made a substantial loss. And the other thing is, when you look in the notes of the accounts in 2019, essentially all of the profit, so they're claiming profit of 580 grand at an operating level, came from Uber Eats compensation, whatever that is. And if anyone knows, please can they let us know in the comments section or drop us a line via email or our Discord channel, because I would like to know what that is. And insurance claims receivable, which together added up to $1 million. And that doesn't seem, I don't know, the insurance, certainly the insurance claims are not so sustainable. And then if we look at the balance sheet, you will see that retained earnings are strongly negative. And so this is a company that over its listed life has lost money for shareholders and has struggled to make a consistent profit. The other thing to note is the positive changes in working capital during the year, and we'll go into that. So this is consolidated cash flow statement, and the company was actually cash flow positive during the year because of changes in working capital and the business support loan from the government. Now, there were 980 grand's worth of rent concessions, which is good. And they halved wages and salaries and cut the headcount by 15% and cut directors' pay by 50%. But you'll notice that in an average year, the directors of this company are earning a total of £626,000 a year, and investors are earning zero. Okay, now, when we talk about changes in working capital, you'll see that they cut inventories because obviously restaurants were closed for a period. They also managed to cut receivables, but increase payables. And so you had actually a substantial change in working capital of 2.8 million. But that obviously will unwind when the restaurant gets back to business, you would think. Certainly the inventories are going to have to rise, and you wonder whether they can pull this trick off again. As a result, the net total liabilities of the company actually fell during the year, despite the increase in bank borrowings because of the changes to the leases. Those of you who have watched our piece on IFRS 16 will know that the rent concessions need to go through the P&L account. So an interesting aspect of Comptoir's accounts are that they had to restate 2018 results to include the effect of IFRS 16. So we have the accounts before IFRS 16 and restated afterwards. And this is really interesting. And thank you to our friend of the podcast, Hasib, for pointing this out to me. So on the left, we have the original numbers, and you see they had an operating profit of 165 grand and a loss of 316 grand. Now, under IFRS 16, their operating profit is boosted enormously. And so it now looks like at an operating level, they made a profit of 444k. But remember, that now excludes rent, and all rents are now financing charges. So after accounting for the financing charges, they now make a loss in 2018 of 760 grand. So IFRS 16 has exaggerated the losses, and viewers who have seen our piece on IFRS 16 will know that one of its effects is to depress profits or increase losses in the early years of the lease, and particularly if a company has high borrowing costs. Okay, so these are the long-term accounts of Comptoir Group, and these are in 6 monthly increments. And you'll see that the cash balance on the balance sheet looks good. And it had no long-term debt until it took out the CBILS loan, and now it has. But it's also, most of its debts are lease obligations. And retained earnings are not good. It's never made a consistent profit. Even during the good times, it was retained earnings were strongly negative. And on the income statement, you can see the effect of last year, where essentially revenues fell by 60%. In 2020, it lost essentially the equivalent of its current market cap. And this is the cash flow statement. If you are interested, pause the video and take a look. Now, who are the shareholders? Well, Tony Cattouz owns 47.6%, and I take it another director owns 18.4%. So between them, they own, what's that, 65% of the company. And then Tellworth Investments, which is a boutique equity manager, owns 7.5%, and other large investors own further 6%. So essentially named shareholders own 94% of the company. This is a very tightly held company and with a limited free float. So the shares are difficult to get hold of, and the chance for a hostile takeover bid essentially is zero. And if you look at the recorded traded volume on the London Stock Exchange, you can see it's incredibly low. So when our Discord member Sahil mentioned that he'd bought some, I could see exactly how much he'd bought, because it was the only trade that went through that day. And you'll see there are some days where nothing goes through. There's, on the 2nd of September, total trading from the entire day was worth 80 quid. So this is not a share you can get hold of in any size, frankly. Okay, so moving on to the positives. So it's probably doing quite well at the moment, in that diners are back out and spending money. And the restaurant group is reporting that although footfall has not recovered to 2019 levels, spending has. So people are opening their wallets and spending more than usual. It has also high-graded its portfolio and has agreed lease modifications, all of which should boost profitability this year. And its franchisee, HMS Host, remains keen and will be opening 2 international restaurants shortly in Doha, which we think may be open, and Abu Dhabi. Negatives. Well, it's never really made a consistent profit. You would hope to see in the good times decent margins, and it has no margins, even in the good times. And when we look through the accounts, it just seems that the central administration costs are just way too high for this business. And we know that cost pressures are rising everywhere, in wages, in distribution, and in food and energy inflation. So although Comptoir Group may be doing okay at the moment, it's only a question of time before margins get squeezed again. And it's a restaurant chain. Does it have any pricing power? Well, history would suggest no. And as we've discussed, the shares are illiquid and closely held, so it'd be very difficult to build up a sizable position in this company. And what is going to be a catalyst to crystallize value? So in summary, I think this has got poor fundamentals, and in the short term, you could well see an uptick in trading leading to a blip in the upwards in the share price, but medium term, I'm skeptical that this will create shareholder value. Richard, your thoughts?
Thanks, Keith. A nice, detailed examination of their accounts there. I mean, I agree with you. The distribution costs, they don't seem to bear an appropriate proportionality to the turnover, do they? And it kills the profitability. And the gross profit is very acceptable, 75% or something. And until you could see that the business has changed its cost structure, you can't see the profitability increasing, even with a sort of steady state type of marketplace, which we don't have, as you point out. Then, as you say, the very small free float and the enormous bid offer spread.
Yes.
And the fact that if you were to try and buy in some sort of volume, you would be moving the price very considerably on your own, I'm sure. It means it's an interesting one to watch to see whether they manage to move themselves back into profitability, address their cost structure, and so forth. But it's not even it would be very difficult to buy and hold it, even, wouldn't it? Because you need to see that they've addressed the cost structure issues before you'd be interested in it. And then the tiny free float, even if it's interesting from the cost structure point of view, the tiny free float makes it very difficult to invest.
Yeah, absolutely.
So I'd say it's a very interesting. You've analysed it very clearly, very carefully, Keith, and I think it's very interesting. And it doesn't, as you say, weak fundamentals plus the very small free float make it really difficult to consider it as something one would want in one's portfolio. Yeah.
Okay. Thank you once again to Sahil for bringing this to our attention. Actually, analysing it taught me a lot, in particular IFRS 16, which I think, all investors should be aware of now. If you have large lease liabilities, it really messes up the P&L account, and you need to be aware of the fact that rental charges now appear after operating profits as finance charges. And if you're unaware of that, it would seem that Comptoir Group was making good operating profits. It's not after accounting for rent, essentially. So in the meantime, please can you press like and subscribe to the channel. And it is goodbye from Richard Wheater.
It's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.